Hi, my name's Griffin Bridgers. I'm an attorney and legal educator, and I'm here today to tell you a little bit more about the Corporate Transparency Act, what it is, who it affects, and what you need to do to prepare yourself for reporting obligations that will kick in starting in the year 2024. The Corporate Transparency Act will impose reporting requirements on business entities which are created by the filing of documents with a state agency, such as a Secretary of State. The purpose of the Corporate Transparency Act is to limit the concealment of funds by requiring certain business entities to disclose the identifying information of individuals who own or control the business entity. Business entities that are subject to the Corporate Transparency Act can include LLCs, corporations, limited partnerships, and other forms of business entities that must be registered with a state Secretary of State office or similar agency. This information will be disclosed to FinCEN through a reporting portal, which will be opened on or after January 1 of 2024. The Corporate Transparency Act also applies to certain foreign business entities which must register to do business in the United States. It's important to note that the Corporate Transparency Act doesn't apply to all business entities. Some entities are exempt, as we'll later explain. So who is affected? There's two categories of business entities that will be subject to the Corporate Transparency Act, which we're going to call reporting companies. However, we can break this down into two classes of entities, which I'm going to call existing entities and new entities for purposes of this video. The first compliance phase will kick in 2024 for new entities. New entities will be those reporting companies that are created on or after January 1 of 2024. Generally, new entities will have a deadline of 30 days after creation to file their initial report with FinCEN. However, it has been proposed but not finalized that new entities created during 2024 may have 90 days to file their initial CTA report. The second phase of reporting applies to existing entities, in other words, those entities that exist prior to 2024. For existing entities, there's a deadline of January 1 of 2025 to file their initial CTA report. As I mentioned, some entities may be exempt from the Corporate Transparency Act's reporting requirements. Thus, exempt entities are not treated as reporting companies. While this video won't cover all forms of exempt entity, generally, those are going to include entities that are already registered and have disclosed similar owner information to a federal agency such as the SEC. Types of entities included could be investment funds, banks, investment advisors who must register with the SEC, certain publicly traded companies or publicly registered companies, and nonprofits and entities serving nonprofits may be included as well. There's also a large entity exemption that looks to whether an entity has more than 20 full-time employees and prior year revenue from U.S. sources of more than $5 million. If those requirements are met, then larger businesses may be exempt as well. So what information must be reported? Generally, there's going to be three categories of persons who must report certain information. Those are going to include reporting companies, beneficial owners, and company applicants. Reporting companies will be responsible for the submission of information for all three categories: reporting company itself, the beneficial owners, and company applicants. Generally, a reporting company must disclose its name, any trade names or names under which it does business, its tax ID number, its street address at which it conducts its principal operations within the U.S., and also the state or foreign country under which the entity was first created. Beneficial owners must disclose their name, date of birth, their residential street address, and in addition to this, they must provide an uploaded image copy of a government-issued ID along with a separate entry for the ID number of the image that's being attached. Company applicants must include their name, date of birth, the business address from which they operate, and similar to beneficial owners, they must provide an uploaded image of a government-issued ID along with a separate entry for the ID number attached to that uploaded government ID. So who is a beneficial owner? The Corporate Transparency Act generally defines beneficial owners as individuals owning 25% or more of a reporting company. This ownership can be direct or indirect, and in situations where multiple classes of ownership are involved, that 25% threshold is determined either by voting power or by value of the business entity itself. For individuals who don't meet that 25% ownership threshold or who are not owners at all, they may still be classified as beneficial owners if they are treated as exercising substantial control over the reporting company. While this is not intended to be an all-inclusive list, this can include individuals like a manager of an LLC, a general partner of a partnership, a director of a corporation, or for all forms of business entity, the highest appointed officer of that business. This can also include a general counsel of a business entity as well. While a trust is not a beneficial owner, you can look through the trust at the individuals who control it to determine who is indirectly a beneficial owner. This will usually include the trustee of an irrevocable trust and possibly the settlors of a revocable trust. In certain circumstances, this could also include a beneficiary who exercises substantial control over the trust as well. Next, we're going to discuss an important concept that can save you some time called a FinCEN Identifier. Starting in 2024, all affected parties, reporting companies, beneficial owners, and company applicants can apply for and obtain a FinCEN Identifier through a one-time submission of the required information I previously discussed that has to be reported to FinCEN. A FinCEN Identifier can be a great way to abbreviate filings when the same beneficial owners or company applicants or even reporting companies are included on multiple reports. In a situation where one reporting company owns an interest in another, if the beneficial owners of each reporting company are identical, then it's possible that the reporting company that owns an interest in another reporting company could have its FinCEN Identifier used in place of the beneficial owners of that higher level reporting company. Similarly, in a situation where an exempt entity owns an interest in a reporting company, the reporting company could simply include the name of the exempt entity on its report, and it does not have to actually disclose the beneficial owners of that exempt entity, who technically, under the definitions of the Corporate Transparency Act, wouldn't be treated as indirect beneficial owners of the underlying reporting company. Finally, we have to look at who is a company applicant. Generally, a company applicant will be any individual who files the document to initially create or register a reporting company with the State Secretary of State or similar agency. A company applicant could also include any individual who supervises the filer of that document. Like with beneficial owners, company applicants can obtain a FinCEN Identifier by submitting their information to FinCEN when the portal opens. This can be a time saver for parties and offices who must file multiple reports for multiple reporting companies. The Corporate Transparency Act is sure to raise some questions for you. You may also want assistance with the filing of your initial or even updated reports, determination of who the beneficial owners might be, and possibly even determination of whether one or more of your business entities are exempt. If you have questions, you can reach out to the sponsor of this video identified here. Thank you for listening to this brief introduction to the Corporate Transparency Act.